Hey guys, today I'm going to walk you through my top 5 picks for Canadian growth ETFs, with the last one being my favorite. I'll break down each ETF, talk about their holdings, their historical performance, fees, and why I think they're solid options. Later, I'll also share a bonus tip on how to save hundreds, even thousands of dollars on taxes just by investing in the right place, something many beginners don't know. Alright, let's get started. The top 5 ETFs I'll talk about today are all listed on the Toronto Stock Exchange and priced in Canadian dollars, so you don't need to worry about foreign exchange fees. These are also ETFs that invest in equities or stocks. Side note, there are many kinds of ETFs depending on what kind of assets they hold, including bond ETFs, commodity ETFs, real estate ETFs, also known as REITs, and crypto ETFs. But disclaimer, this is not investment advice, so make sure to do your own research. First up, we have VCN, issued by Vanguard. Now, Vanguard is a name you can trust in the ETF space. They're known for their low fees and solid performance. The VCN specifically tracks the FTSE Canada All-Cap Domestic Index. All-Cap simply means that it contains a mix of large, mid, and small Canadian companies. Think of it like a diversified slice of the Canadian pie. We're talking 100% Canadian stocks here, with 164 companies in its holdings. You can actually go on Vanguard's website and see exactly what companies the VCN holds, which is awesome for transparency. They list the top 10 holdings with their weightings, so you can see how much of the ETF is allocated to each company. For example, you'll find big names like RBC and Shopify in there. The beauty of an ETF like VCN is that you don't need to spend hours researching individual stocks, trying to pick winners and losers. Instead, you get exposure to a broad range of established Canadian companies all at once. This diversification helps mitigate risk, because even if one stock takes a hit, the others can help balance things out. Next up is the XEQ, issued by BlackRock, another giant in the ETF world. This one's a bit different. It's an international ETF that holds investments mainly in the US and Canada, but also dips its toes into Japan, a few European countries, Australia, and even China. Talk about going global! What makes the XEQ unique is that it's actually an ETF made up of other ETFs. It's like ETF inception. By investing in the XEQ, you're indirectly investing in a whopping 8,646 companies across the globe. That's some serious diversification. And if you're curious about what those companies are, you can check out the top holdings section on BlackRock's website. You'll find familiar names like Apple and Nestle in there, alongside companies you might not know as well. This ETF is like a one-stop shop for global market exposure. Chapter 3, XUU, Riding the US Growth Wave. Now, let's talk about the XUU, also issued by BlackRock. This ETF aims to replicate the performance of the S&P Total Market Index, which, as you might guess, is focused on the US market. With the XUU, you're getting a piece of 2,528 companies in the US, spanning large, mid, and small cap companies. While this ETF doesn't offer the same global diversification as the XEQ, it provides broad diversification within the US market itself. Think of it as betting on the overall strength and growth potential of the US economy. And historically speaking, it's been a pretty good bet. The XUU has seen impressive growth since its inception in 2015, and with its low MER of 0.07%, it's a cost-effective way to tap into the US market's potential. Chapter 4, ZNQ, Tech-Powered Growth with the NASDAQ 100. Now, for all you tech enthusiasts out there, let's talk about the ZNQ, issued by BMO. This ETF tracks the performance of the NASDAQ 100, which, as you might know, is heavily weighted towards technology companies. We're talking big names like Apple, Amazon, and Microsoft, alongside up-and-coming players in the tech space. The ZNQ has been a phenomenal performer in recent years, reflecting the overall growth of the tech sector. However, it's important to remember that past performance doesn't guarantee future returns. The tech sector can be volatile, so it's essential to consider your risk tolerance before jumping in. That being said, the ZNQ's historical performance and its focus on a sector with massive growth potential make it an intriguing option for investors looking for potentially outsized returns. Chapter 5, VFV, my top pick for long-term growth. And finally, we've arrived at my personal favorite, the VFV, issued by Vanguard. This ETF tracks the S&P 500 index, which consists of 500 of the largest publicly traded companies in the US. By investing in the VFV, you're essentially buying a tiny piece of each of those companies. Think Apple, Microsoft, Amazon, Google, the whole gang's here. And the best part? It's passively managed, meaning you don't have to worry about some high-priced fund manager making questionable decisions with your money. The VFV has a long and impressive track record, consistently delivering solid returns for investors. Plus, with its ultra-low MER of 0.09%, it's one of the most cost-effective ways to invest in the S&P 500. If you're looking for a set-it-and-forget-it investment that has the potential to grow your wealth over the long term, the VFV is definitely worth considering. And how they can supercharge your investment returns. See you in the next one.